Hello, let us look at deferred revenue. And deferred revenue is payments received by a business before it has provided the goods or services. Okay, so this means you have a client who has come and paid for something, but you're yet to give them, whether it is the goods, it's goods that you are selling, or it is services that you are providing. You are yet to provide this to this client, but they have already paid you. And recall, in accrual accounting, we don't record revenue just because we have received a payment. No, we record revenue because we have earned, we have provided the benefit of earning this revenue. So as before you actually provide these goods or services, you're yet to earn that revenue because you've not given out the benefit to earn this revenue. So this is where we record this as deferred revenue. And deferred revenue is classified as a current liability. A current liability. Why? Because it is a liability as it sits in there in our books till we provide these goods or services to this client, because we still have not transferred a benefit for this payment that we have been given. Okay, so deferred revenue is basically a current liability. Mostly deferred revenue is expected to be settled within 12 months in most cases, so that is why I'm classifying it as current liability. So in some instances, depending on the operations of a business, if you find this deferred revenue is going more than the 2 years or more than 1 year, basically, then it can be classified as a non-current liability. But basically, it is a liability, okay? Because we have been paid, but we have not provided what the services or the goods that we are being paid for. So we owe this client of ours something, okay? Okay. So let us look at a practical example to assist us to understand what we mean by this deferred income and how we pass the adjusting journals to record this. Okay, so we have a customer pays Kenyan shillings 30,000 in cash in December, okay, for a 3-month gym membership. Okay, so they paid let's say this was December 2025. Okay, at the end of December 2025 for a 3-month gym membership. They were renewed now for the period January to March. Okay, so they were paying for gym membership for the month of January, February, and March. So how do we record this? Let's start at the beginning to recognize the payment. When we want to recognize the payment, because we have received this payment at the end of December, okay, and this is for the period January to March 2026. Okay, they're paying for membership for January to March 2026. So at the beginning of that, when to recognize, first to record the payment, we come and debit cash. Why are we debiting cash? Because we have received money. So we need to recognize that our cash account has increased by 30,000. Okay, and as at this point, we have not yet earned the revenue. Why? We have not provided the gym services to this client because he or she has paid for the gym membership from January to March. He is yet to come to the gym and use the services, and we provide the services, or rather use the gym, and also we give him him or her the services that come up with his subscription. Okay, so we are yet to give that to this client. Okay, so we are yet to earn the revenue. So what do? We recognize now what we call deferred revenue. Deferred revenue account. Okay, an amount of 30,000. Okay, always refer to the simple word to use to know when to debit and when to credit, that is dealer. Okay, remember the expanded accounting equation where we said accounts on the left side, we actually debit to increase them and credit to decrease them. But on the other side, it is the opposite. Okay, we actually let me write on this side, we actually, to increase them, we credit, and to reduce them, we debit. Okay, and you can see we said deferred income is a liability account. L here stands for liability, and to recognize an increase in a liability account, what do? We credit. That is why we are crediting here deferred revenue account, to recognize there is an increase of 30,000 to that account. Okay, so let us look. Once we get to January, at the end of January, 2026, how do we record this? Okay, we come and debit deferred revenue. When you debit a deferred revenue account, which is a liability account, what are you doing? You are reducing, and you're supposed to reduce only to the level that you have earned. If 30,000 was for 3 months, you're told 30,000 was for 3 months, how much in 1 month, how much is the cost of 1 month? And that is basically 10,000. So we are only reducing up to 30,000. It's no longer a liability. 10,000 is no longer a liability. Why? Because we have provided the services to these. The client has come to the gym for this 1 month of January. Okay, so we no longer need to recognize it as a liability, and now we need to recognize the revenue, because now we have earned that revenue. So this is where we come and credit revenue account. We can call this gym membership fee. Okay, it is basically a revenue account. Some could just write a general account, call it a revenue account, of amount 10,000. Remember, we have only earned 10,000 as at this point, as at the end of January 2026. Okay, the same thing will happen for in February and March. Okay, the same adjustments are going to be done each for those months, at the end of January, at the end of February, and at the end of March. How will our T accounts look like? Let us look at T accounts for first deferred revenue. Deferred revenue. By the way, deferred revenue, you'll find in some places it's an earned revenue. Some place they call it prepaid revenue. Okay, it's all the same thing, and it is a liability. Okay, so at the beginning, what did we do? We recognized a revenue of 30,000, right? And then during the 3 months, we came at the first month, at the end of January 2026, we came and debited another we debited 10,000. Okay, then at the end of February, we debited another 10,000 because it was no longer a liability. This person has used the gym in February. And then at the end of March, we debited another 10,000. How will this look like? Here we have 30,000 on the credit side, and debit on that year 30,000. So this is basically a balance of 0. Okay, when you take this here, you're going to have a 0. Okay, on our credit balance is going to have a 0 on deferred revenue. Okay, so this is just an adjusting entry used to recognize to recognize that this revenue is yet to be earned. Okay, now how will our revenue account look like? Our revenue account, what will it look like? We have debit, we have credit. Okay, so in the first month, we credited 10,000. The second month we credited 10,000, and the third month we credited 10,000. Okay, remember at the beginning we recognized the cash, okay, and credited deferred revenue. Then over the 3 months, we are going, at the end of each month, we are going to pass this the double entry. So this is where we are taking this 10,000 for January, 10,000 for February, and 10,000 for March. So we are going to have here a credit balance of 30,000. And remember, this is a revenue account and a revenue account. A revenue account. Remember, here it is. A revenue account, you actually credit to increase that account. You can see you credit to increase that account. Same to liability, and here as well, this is actually equity. Okay, don't confuse, this is equity and this is expenses. So always have in mind this dealer wall to assist you when to know. So here we had revenue, we have to credit, that is why we were passing this credit, and we are reducing deferred revenue while we are increasing the gym membership fee. So we have a balance of 30,000 in our revenue account, which is basically what we have earned as at the end of the period, as at the end of March now, because we have provided the required services to this client. Okay.